There is a piece of financial vocabulary that almost nobody outside a family office will ever hear spoken aloud. It isn't a tax strategy. It isn't a trust structure. It's a single, blunt phrase that old money uses to describe something most people spend their entire working lives trying to acquire: a house. They call it dead capital, not an asset, not an investment. Dead capital, as in money that has stopped moving, money that has been converted into brick, stone, and soil, and in the process has stopped doing the one thing capital is supposed to do, which is work. This is going to sound backwards. The popular imagination has spent a century telling us that real estate is the bedrock of family wealth, that owning land is what separates the rich from everyone else. And it's true that old money owns extraordinary amounts of real estate: manor houses, townhouses, ranches the size of small countries. But here is the mechanism almost nobody explains correctly. The families who have preserved wealth across 5, 6, 7 generations do not think of that real estate as their wealth. They think of it as a cost center wearing a nice suit. Understanding why requires understanding a distinction that gets erased every time real estate is discussed on personal finance content: the difference between an asset and a productive asset. Today we're going to walk through exactly how that distinction works, where the phrase dead capital actually comes from, why a $40 million townhouse can sit on a family balance sheet as a liability, and the specific mechanisms, leverage, structuring, and land versus building economics that old money uses to keep real estate from quietly draining a fortune over 100 years. This isn't hidden, it's just never taught. Let's get into it. What dead capital actually means. The term itself has a documented origin, and it's worth being precise about it because the internet has a habit of turning useful economic vocabulary into vague conspiracy language. The phrase dead capital was formalized by the Peruvian economist Hernando de Soto Polar in his 2000 book, The Mystery of Capital. De Soto used it to describe a very specific problem: assets, usually land or housing, that have real economic value but cannot be leveraged, sold quickly, or used as collateral because of missing legal infrastructure, like clear title systems. In his original framing, dead capital was a development economics problem, describing why poor households in the developing world couldn't convert their homes into working capital the way a formal landowner could. Old money and family office practitioners borrowed the term and repurposed it for something adjacent but distinct: the problem of capital that has full legal liquidity available to it, clean title, functioning markets, willing buyers, but has nonetheless been parked rather than deployed. In this usage, dead capital doesn't mean an asset nobody can legally sell. It means an asset that has been allowed to stop generating a return relative to what it's worth. Here's the plain language version. A dollar of capital is alive when it's doing one of two things: generating income or compounding in value at a rate that outpaces its carrying cost. A dollar of capital is dead when it just sits there, when the only thing happening to it is erosion from taxes, maintenance, insurance, and opportunity cost, with no offsetting cash flow. A primary residence in this framework is close to the textbook case of dead capital. Consider the actual mechanics. A family buys a $10 million house. That $10 million no longer sits in an index fund, a private equity vehicle, or a family business, quietly compounding. Instead, every year, that same $10 million asset now requires property tax, often 1 to 3% of value annually, depending on jurisdiction. It requires insurance. It requires a maintenance reserve, conventionally modeled by family offices and real estate consultants at somewhere between 1 and 4% of value per year for a large or historic property. None of that spending generates a dollar of income. The house doesn't pay the family rent. It simply consumes capital every single year in exchange for the privilege of being lived in. Compare that to $10 million left in a diversified portfolio of productive assets, equities, private businesses, income real estate. Historically, that kind of portfolio has generated a real inflation-adjusted return, the low to mid-single digits over long horizons, on top of which many of the underlying assets throw off dividends or distributable cash flow. The house, meanwhile, needs the family to keep feeding it capital just to stay in the same condition it was in on closing day. This is why old money family offices, when they build internal balance sheets, frequently separate real estate used for personal enjoyment. The primary residence, the family compound, the ski house, into its own category, sometimes literally labeled lifestyle assets or consumption assets, and explicitly exclude it from the investment portfolio figures used to calculate the family's actual growth rate. It is treated the way a yacht or a private jet is treated, something the family can clearly afford, but not something doing the work of preserving the family's wealth. If this is your first time here, this channel exists to decode exactly this kind of mechanism, the quiet architecture behind generational wealth that nobody sits you down and explains. Subscribe and turn on notifications, because next week we're breaking down the specific legal structures families use to convert dead real estate back into productive capital, and you won't want to miss it. Why real estate fails the old money test. To understand why land and houses get demoted to lifestyle asset status, it helps to understand the actual criteria. Old money applies when deciding whether something belongs in the wealth preservation category of a portfolio versus the consumption category. Multi-generational family constitutions and family office investment policy statements, the internal documents that govern how a dynasty's capital gets allocated, tend to converge on a similar checklist, even when the families involved have never spoken to one another. An asset earns a place in the productive column if it satisfies most of 4 conditions. It generates cash flow. It can be sold or partially sold within a reasonable window without destroying its value. It doesn't require the owner's ongoing operational involvement, and its carrying costs are low relative to its value or income. Run a personal residence through that checklist, and it fails almost every test. Cash flow. A home you live in generates 0 income. 0. Unlike a rental property, an operating farm, or a commercial building leased to tenants, a primary residence produces no revenue at all. It only produces expenses: property tax, insurance, staff, utilities, capital repairs. Family offices sometimes describe this internally as negative carry, a term borrowed from trading desks, where the cost of holding a position exceeds any income the position produces. Liquidity. Real estate, especially large or unusual properties, is famously illiquid. Selling a diversified stock portfolio can take minutes. Selling a $30 million historic estate can take years and often requires accepting a steep discount to get there quickly. Real estate transaction costs alone, brokerage commissions, transfer taxes, legal fees, frequently run 6 to 10% of sale price in many markets, a friction cost that a family absorbs every single time the asset changes hands. Operational independence. A single stock position requires nothing from its owner. A great house requires almost constant stewardship. Roof cycles, mechanical systems, staff management, land management if there's acreage attached. This is not a passive asset. It behaves more like an unpaid, unglamorous part-time job, carrying cost relative to value. This is the one that does the most damage over multiple generations, and it's the one almost nobody calculates honestly. Assume a family holds a $20 million property with a conservative 2% annual carrying cost, taxes, insurance, and a maintenance reserve combined. That's $400,000 a year, every year, indefinitely, simply to keep the asset in the family without it generating a cent back. Over 30 years without even accounting for major capital projects like roof replacements or systems overhauls. That's $12 million in pure cost, more than half the value of the original asset, spent to hold something that may or may not have appreciated enough to offset it. This is the arithmetic that separates families who understand dead capital from families who don't. A house can go up in value and still be destroying wealth in relative terms if the carrying cost and the opportunity cost of the capital tied up in it exceed what that same capital would have earned deployed productively elsewhere. Old money doesn't ignore this arithmetic. It's the entire reason the phrase exists. The distinction: old money never forgets. Land versus building. Here's where the mechanism gets genuinely interesting, because old money doesn't treat real estate as one category. It splits it in two, and the split matters enormously. Land and what sits on top of the land. Land, properly held, is one of the only physical assets that can appreciate indefinitely with no maintenance requirement at all. It doesn't have a roof that fails. It doesn't have plumbing that corrodes. Left alone, raw land simply exists, and depending on location, scarcity, and use restrictions, its value can compound for centuries with minimal input. This is precisely why old European aristocratic families historically prized agricultural and forestry land, why American dynasties, like the family behind Rockefeller Center, were fixated on ground leases, and why land, and as opposed to the structures built on it, has functioned as one of the closest things to genuinely alive, real capital in old money portfolios. Buildings are a different animal entirely. A building is a depreciating physical structure from the moment it's finished. Roofs fail on a 20 to 40-year cycle. Mechanical systems, heating, cooling, plumbing, electrical, typically need major overhaul every 15 to 30 years. Facades need repointing. Interiors need updating simply to remain functional, let alone desirable. Unlike land, a building actively fights entropy, and every dollar it takes to fight that entropy is a dollar diverted from the family's productive capital. This is the exact insight behind one of the most famous real estate structures in American business history. The ground lease arrangement underlying Rockefeller Center in Manhattan. Rather than simply owning the buildings outright as a static asset, the structure separated land ownership from building operation, allowing the underlying land value to be treated and financed as a distinct, appreciating instrument from the depreciating structures built above it. Ground leases of this kind let a family retain permanent ownership of the appreciating component, the land, while pushing the cost and risk of the depreciating component. Construction and operation of buildings onto a separate operating entity or tenant. It's a structural solution to the exact dead capital problem we've been describing, It keeps the alive part of the asset, land, working, while quarantining the dead part, the building, so it doesn't drag down the whole position. This same land versus structure logic shows up in English landed estates, where centuries-old families have historically retained enormous agricultural and forestry acreage, while systematically leasing out farmhouses, cottages, and commercial buildings to tenants who bear the operating and maintenance burden. The family keeps the appreciating land asset. The depreciating structures become someone else's operating responsibility, generating rental income back to the family in the process. It converts a piece of dead capital, a house, into a piece of income-producing property, without the family ever having to manage a boiler. We've covered the buy, borrow, die framework and the mechanics of dynasty trusts in earlier videos on this channel, and land versus structure economics connects directly to both. If you want the next video to walk through exactly how ground leases are structured in practice, the legal mechanics, not just the concept, drop ground lease in the comments below and we'll build the next deep dive around it. How old money revives dead capital. Understanding that real estate tends toward dead capital is only half the picture. The more instructive half is watching what old money families actually do about it, because the wealthy don't avoid real estate. They own enormous amounts of it. What they avoid is letting it sit passively as dead weight. There are 4 recurring mechanisms worth understanding, and each has shown up repeatedly across documented family office practice. Mechanism 1: leverage against the asset rather than liquidating it. This is the real estate application of the buy, borrow, die strategy covered in an earlier video on this channel. Rather than selling appreciated real estate, which triggers capital gains taxation and permanently removes the asset from the family, old money frequently borrows against real estate using a mortgage or a securities-backed line of credit, taking cash out at historically low interest rates while the underlying asset remains in the family and continues to hopefully appreciate. That borrowed capital is then redeployed into productive income-generating investments. The mechanism effectively unfreezes a portion of the trapped equity in the dead asset and puts it back to work without ever triggering a taxable sale. Mechanism 2: convert consumption real estate into income real estate through structuring. A family that owns far more real estate than it personally uses, inherited estates, secondary properties, historic buildings, will frequently place those assets into a holding structure, often an LLC or a family limited partnership, and lease them out commercially or agriculturally, converting what would otherwise be a pure cost center into a cash-flowing line item. Wineries on family land, weddings and events hosted at historic estates, agricultural leases on unused acreage, museum or conservation partnerships that come with tax-advantaged treatment in exchange for public access commitments. Each of these converts a piece of dead capital into a productive one, even while the family retains ownership and, often, personal use rights for part of the year. Mechanism 3: sale-leaseback and partial disposition. Some families, particularly ones managing real estate that has become disproportionately large relative to the rest of the portfolio, will sell a property outright or sell a majority stake in it, while retaining a minority interest or a long-term lease that preserves continued personal use. This lets the family extract the bulk of the trapped capital and redeploy it productively, while retaining emotional and practical continuity with a beloved property. It's a documented pattern in family office literature discussing concentration risk in real estate holdings, where a family recognizes that having, say, 40% of total net worth tied up in one illiquid, non-income producing property is itself a risk to be actively managed, not simply accepted as the cost of legacy. Mechanism 4. The disciplined refusal to treat home equity as retirement capital. This is subtler, but it shows up consistently in how family constitutions instruct younger generations. Old money financial education, the kind covered in this channel's earlier video on the unwritten financial rules taught to heirs, explicitly teaches that a primary residence should never be counted as part of a family's investable net worth for planning purposes. The house is where you live. It is not the fund that pays for your grandchildren's education or the reserve that keeps the family business capitalized through a downturn. Keeping that mental separation intact, generation after generation, is one of the quieter disciplines behind long-term wealth preservation, and one of the more commonly cited reasons newly wealthy families erode their fortunes faster than dynastic ones. They let the house count as the retirement plan. Case study: the dynasty that got it right and the one that didn't. To make this concrete, it helps to look at two illustrative composite family patterns, reflecting well-documented historical structures rather than any single living family, that show the dead capital principle playing out in opposite directions. Consider a composite landed estate family, modeled on patterns common to English and continental European aristocratic land management over the 19th and 20th centuries. These families frequently held vast agricultural and forestry acreage passed down through primogeniture. The land itself, in many documented cases, was never treated as a static trophy. It was farmed, leased, timbered, or otherwise placed into productive use, generating recurring income that funded the maintenance of the family seat itself. The house, the actual dead capital liability, was in effect subsidized by the productive land around it, rather than the other way around. When land reform, inheritance taxation, or economic pressure forced difficult decisions across the 20th century, the families that survived tended to be the ones who had kept this income-generating discipline intact, selling off unproductive structures or converting them to trusts, heritage foundations, or commercial use, rather than families who had let the entire estate slide into pure consumption. Now consider the far more common composite pattern: a newly wealthy family, often 3 generations removed from the original fortune, that converts an outsized share of liquid, productive wealth into a single trophy property, a signature mansion, a landmark apartment, a compound built to signal arrival. Family wealth research repeatedly documents this exact pattern as one of the recurring mechanisms behind the shirt sleeves to shirt sleeves phenomenon discussed in an earlier video on this channel. A family converts productive capital into dead capital in pursuit of status. The carrying costs quietly compound across decades. No one in the family has the discipline or knowledge to reverse the conversion, and by the 3rd generation, the trophy property is often the single largest asset the family owns, and also the single largest reason the rest of the fortune has eroded. The house doesn't just fail to build wealth, it actively consumes the wealth that's left, one property tax bill and one roof repair at a time. The distinction between these two patterns isn't about how much real estate a family owns. Aristocratic landholding families, in absolute terms, often owned vastly more real estate than any nouveau riche trophy house family ever will. The distinction is entirely about whether the real estate was harnessed as productive capital or left to exist as pure consumption, whether it was treated as an asset that had to earn its place on the balance sheet or a trophy exempted from that discipline entirely. If this reframe of real estate as a liability wearing a nice suit rather than an automatic wealth builder changed how you think about the house you live in, hit like on this video. It genuinely helps this kind of long-form, research-heavy content reach more people who are tired of surface-level financial advice. Why this matters even if you'll never own an estate. It would be easy to hear all of this and conclude it's only relevant to families managing 8- and 9-figure portfolios. It isn't. The underlying principle scales all the way down, and it's arguably more urgent for ordinary households than for dynastic ones, precisely because ordinary households have far less margin for error. The core insight translates directly. A primary residence is a lifestyle asset, not an investment, and treating it as your primary retirement or wealth-building vehicle is a documented pattern behind a great deal of retirement shortfall in middle-class households. It's not that homeownership is a mistake. Stable housing has genuine, well-documented value, financial and otherwise. It's that conflating the roof over my head with my investment portfolio leads to the same mistake at a smaller scale that erodes newly wealthy families at a larger one. Overconcentration in a single, illiquid, non-income producing asset with carrying costs that quietly compound year after year, while the rest of the household's capital building gets neglected because the house is going up in value, feels like enough. The old money mental model, separate what you live in from what builds your wealth, and hold the second category to a much higher standard of productivity, is genuinely useful advice at any wealth level. It's simply never taught because the entire consumer real estate industry and a great deal of mainstream financial content has a structural incentive to keep buying a house and building wealth, sounding like the same sentence. So the next time you hear that a family is worth however many hundreds of millions of dollars, and a headline lists their real estate holdings as part of the total, remember what's actually happening underneath that number. A serious portion of that real estate isn't generating a cent of income. It's costing the family money every single year to hold, and the families who've actually preserved their wealth across generations know that better than anyone, which is exactly why they don't count it the way outsiders do. Dead capital isn't a criticism of real estate. It's a discipline about it. Land can be alive when it's productive. Buildings can be revived when they're leveraged, leased, or restructured rather than simply inhabited. But the moment a family, or a household, starts treating the walls around them as the engine of their wealth rather than the roof over their productive capital, the erosion starts quietly, and it rarely announces itself until several generations have already paid the price. This isn't hidden. It's just never taught. If you want to understand the other half of this mechanism, exactly how families use leverage to keep appreciated assets like real estate working for them without ever selling, go watch our deep dive on the buy, borrow, die strategy next. It's linked on screen now and in the description. Before you go, which category does your own home fall into for you? Lifestyle asset or wealth building asset? Be honest in the comments. It's a more useful question than it sounds.